Thank you all for being here this afternoon, and thank you to Wholesale Investor for having us here today. What I'm going to tell you about over the next 10 minutes is really introduce you to a unique asset class that actually is not available in today's marketplace, a fixed income asset class that generates very good returns. Essentially, the concept of people lending money in small amounts to diversify their risk across a broad base to either individuals who need unsecured loans or to businesses who need growth finance or capital to grow their business is what peer-to-peer lending is. And if you think about the concept, it's the advancement in technology which has given us access to information and empowered us to be able to make decisions and control where we put our money. And that, in essence, is, I guess, the democratization of finance, if you want to call it that. And there are lots of names, disruption being one of them that's used for people like us. And I guess we're also called fintech because while we're in the finance business, we tend to use technology in order to either evidence what borrowers tell us, to make quicker decisions, or to be able to provide lenders with access in a transparent way to their investments on a day-to-day basis. So what's really unique about what we do? For starters, the banking system are the only people who actually have access to SME lending in Australia. So giving communities or individuals and wholesale investors, professional investors, high net worths, and access to this income class is in itself unique. In a low-yield market environment, clearly achieving somewhere between 12 and 16% is quite an attractive proposition. And if you look at the concept of what we actually put up there in terms of our loans, every individual gets to see an individual borrower, their profile, an information memorandum, and a whole list of financial statements, VIDA reports, and a range of other information that would enable you to make a direct decision. And then you actually lend a very small amount in an allocation within a portfolio so you can diversify risk. And so ultimately what this is all about is more than the access to a particular investment class. It's about diversifying risk and creating a portfolio of lending to SMEs. And of course, there's the other added advantage of, and I don't think people talk about this too much, but the economic multiplier effect of recycling money and lending it to SMEs who then will actually employ more people and grow their businesses. The market rationale, very simple. 2.1 million SMEs in Australia, $73 billion of money lent each year to them by the banks. The big four have 91% market share of that market. And usually if you want to get bank finance for a business, you've got to put up your house. So arguably, the banks are being building societies in this area. What we're really doing is trying to create a banking proposition which allows people to repay money out of the cash flows of their business. In terms of losses, again, quite interesting. Over the last 25 years, the actual loss rate, which is actually the rate at which people have not paid for 90 days, is between 1.6 and 2.2%. And that's pretty good in itself. But the actual realized loss rate for the banks, because they have your home as a business, is generally 10 basis points. So it's quite a safe market for bank lending and certainly should be a good market for investors to look at. On the other side of the equation, you've got 400,000 or more than 400,000 high net worth and sophisticated investors who, along with their self-managed super funds, would have close to $2 trillion in investable funds. And I think that's a huge amount of available funding to finance the growth of business. A bit of a snapshot of our business here. We've actually only been going for 12 months, and effectively our average loan size is about $200,000 to $250,000. So we're not playing in, we're differentiating from the short-term sort of low-value, high-interest online marketplace of lenders. And we are really trying to look at secured lending to larger businesses that can actually have growth outcomes. And of course, to do that, we need both a robust technology as well as an experienced management team to originate those loans, to vet them for eligibility for our platform, because obviously if there are lots of defaults, then it's not a sustainable business. We've also kept our product offering to quite a simple one, because the color of money is the same thing for a business, whether you need it for a short or long-term purpose. If you need working capital, you can roll it over. And if you need longer-term acquisition finance, then you have it for that period. So all our loans are principal and interest. Generally, the returns are rated between 14 and 16%, or rather 14 is the average. And I should add that we don't actually take any cut out of it. So it's all the interest that's paid by a borrower goes directly to the lenders. And effectively, in terms of our term of loan, it's between 2, 3, or 5 years, so it's all for growth finance. And whilst we don't have one yet, we intend, after we've had a large enough primary market, to have a secondary market where a lender can sell their fraction of a loan into the marketplace as well. And so effectively, we are, I guess, empowering the community to be able to access business lending. The lending cycle really is about us originating borrowers through our network of accountants and finance brokers and a lot of direct inquiry to our website. We then do a full application form, we create that credit memorandum, and then we list it on our platform for all of our lending members to see. And we've got about 300 or so registered members now who actively come and have a look at a loan and then decide whether or not they want to participate. Usually a $200,000 loan would have about 20 to 25 people participating. And effectively, after the loan is funded, we then do all the security documentation, which is vetted, and we take a charge over the business. We record it on the PPSR. We take personal guarantees of all the directors. And once we've done all of that, then the funds are dispersed to the borrower. And then monthly repayments come in, which go directly into lender accounts, which can be viewed on the dashboard. And we'll put up our default data and all of that sort of thing for complete transparency. At the moment, we don't have any. If there was a default, though, we have a specialist team outsourced once again of collections people who would actually look to get back the funds. But the decision to do that would be made by the lenders in a majority based on your investment in the loan. A bit about the UK, which is where we have our joint venture with. They've been going since about 2011. They've got over 4,600 members who actively participate in loans. They've done close to 153 million or 154 million pounds. And on an average, their loan size is about 250,000 pounds. Now, they've returned a yield of 11.17%, and they've had losses of 1.68 over a 5-year or 6-year period. And I guess with every business, the critical aspect to sustainability is the team. And this is where I would sort of say where we differentiate from fintech is we are actually very old-fashioned bankers with very long-term business experience in lending and in credit, using technology to deliver something to the marketplace. A couple of key people there is one of our colleagues who's here today, Frank Willenberg. He is was the chief risk officer for Citibank, has 35 years of lending experience, and Harsha Nair, our chief operating officer, who's also had experience with the Morgan Stanley, JP Morgan Chase, CBA, and has been a financial controller of sort of a smaller foreign exchange house. And we have Andrew Bowden, who's just joined our team, who's got expertise in marketing to accounting firms. We've also got Alan Kohler on our advisory board, and he actually conducted interviews with a number of peer-to-peer lenders and decided we were the ones he would like to participate in and invest in. And Glenn Baptist, who's one of our advisors, is a 30-year veteran of the investment industry and also happens to be the chief investment officer at Prudential in the US. We've actually got a booth outside. I don't know if too many people have been there because I've actually been presenting at another conference earlier today, but we'll definitely be there after to have a chat, and we'd welcome any questions that you might have there. Thank you.